Welcome to Kaplan Professional's monthly Q&A series. I'm Michael Pollack, and today we're speaking with Chief Economist at St George Bank, Besa Deda, about the interest rate and housing outlook for 2018. Thanks for joining us today, Besa.
Thank you. Thanks for having me, Michael.
Firstly, what's your growth outlook for Australia?
Well, I characterise the Australian economy as being stuck in gear 3, and I think it's likely to be in gear 3 over the next year ahead. And what I mean by gear 3 is that the engine's not sputtering along, but nor are we in a car where our hair is blowing in the wind. So what we're seeing with economic growth in Australia is that the impact of the unwinding of mining investment is almost over, and so that will be less of a drag on economic growth. We are seeing the green shoots in business investment, so the business investment outlook is brightening. At the same time, the residential construction cycle looks to have peaked. And the consumer spending outlook is a cautious one, and that is because we do have low wages growth and high household debt, and also mortgage rates on a number of lending products have risen.
And so what's your outlook for inflation for 2018?
Well, the inflation outlook does look flaccid. So if we have a look at the underlying inflation numbers, the more recent ones that were published, they're running at 1.9% per annum, which is under the RBA's target band of 2 to 3% per annum. And headline inflation is also running under the RBA's target band. Now, we expect that inflation will remain pretty subdued in coming quarters. The RBA, in its most recent statement on monetary policy, doesn't have inflation coming into the middle of the band or in the upper part of the band in the foreseeable future as far as its forecasts are concerned. The inflation outlook does reflect the wages outlook, and wage pressures are weak in the economy. Wages growth is running near a record low. However, we do have a labour market that is tightening and should continue to tighten, and eventually that might produce stronger wage pressures coming through. The share of firms that are reporting greater shortages of labour is rising. But then, as we've seen in other economies around the world, particularly the United States, the unemployment has dropped even below the natural rate of unemployment, and yet wages growth is still weak. So that is something to really keep an eye out over the year ahead.
Where do you see interest rates going in 2018?
Well, we think that the next move from the Reserve Bank will be a rate hike, and that is pretty consistent also with consensus in financial markets. However, we think the RBA won't be raising rates until the first half of 2019. And financial markets, for example, the overnight index swap market, is currently attaching a probability of 80% that the Reserve Bank will raise the cash rate before the end of next year.
And how about the US interest rate outlook? What do you see happening there?
Yeah, so the US Federal Reserve did recently raise rates, so the 5th time in this tightening cycle. The median consensus forecast among the Federal Reserve Open Market Committee is for 3 rate hikes in 2018. We agree with this view that they will be raising rates 3 more times, especially with the likelihood that corporate tax cuts in the US will become law. However, you still have a situation in the United States where wages growth and inflation is a concern, despite the fact that the employment growth is very solid and economic growth has quite a bit of momentum. So the risk is that they might deliver less than 3 rate hikes, particularly if inflation remains an ongoing concern.
Many thanks for your time today, Besa.
Thank you.